India, along with the US, People's Republic of China, Japan, and the Republic of Korea, has decided to release 5 million barrels of crude oil from its Strategic Petroleum Reserves in a concerted effort to bring down global crude oil prices. This is the first of a kind coordinated move globally to tame the flaring crude oil prices. Brent, the most popular benchmark in international trade for crude oil, hit $86.40 a barrel on October 26. While prices cooled off since then to nearly $79 a barrel, they rose over 3% in 2 days to hover around $83 per barrel mark after the announcement. While sector watchers say the quantity is not big, the release of 5 million barrels of crude oil from its SPR is a symbolic gesture on India's part. On an aggregate basis too, the release of oil reserves by all the countries may add about 70 million to 80 million barrels of crude supply, smaller than the more than 100 million barrels the market has been pricing in, say analysts at Goldman Sachs. Let's go to Vandana Hari, founder and CEO of Vanda Insights, to know her take on the joint oil reserve release from SPR.
It was still not the big bang announcement that the market had been anticipating or expecting. First of all, none of these countries have actually revealed any specifics yet. And importantly, those specifics weren't a part of the US announcement, which also took a lot of punch out of the news. And while they may very well release stocks, it's the figures that have come out unofficially through anonymous sources talking to the media suggest perhaps no more than 20 million barrels, give or take, combined from these other 5 countries. So overall, 70 million barrels, it's not a big number.
That said, all eyes now are on the OPEC meeting on December 2 that will set the tone for oil prices. Market watchers fear the coordinated effort by oil-consuming countries may slow their output increase pace.
The SPR release, nevertheless, does leave the door open for OPEC Plus to respond. We do know that they had warned that if countries tap their strategic reserves, then OPEC might be forced to reconsider the 400,000 barrel per day monthly increment that it has been effecting. So we have the energy ministers due to meet next week, December 2nd. And there is a possibility, though I feel personally that they don't necessarily need to respond because prices have not really come under that much pressure after yesterday's news. But there is still a possibility that they revisit the plan. So the market will probably be a little bit on tenterhooks with a little bit of a bullish anticipation, one would say, in case OPEC decides to hold back its additional supply for January or even beyond that.
Going forward, global crude oil prices are likely to remain volatile given fresh surge in COVID-19 cases in European countries and persisting energy crisis.
Going forward in the very short term, of course, the market will be waiting to see what OPEC decides with regard to its production policy. And slightly beyond that, the COVID resurgence in Europe, which is a bit of a downward pressure, without doubt, on crude prices, that is likely going to be a major factor. Personally, I feel the Europe situation is not as bad as the last few waves, or certainly not as bad as last winter. Thanks to higher vaccination rates. By and large, most governments, especially Western Europe, which accounts for the lion's share of oil demand of the region, the Western Europe governments will likely avoid very stringent restrictions, blanket lockdowns, and so on. So while demand rebound in the region, which has been quite strong so far this year, while that might cool off to a slightly more moderate pace. I am not expecting to see major deceleration in the demand of the region. So on balance, oil looks fairly well supported. I think at least for the rest of the winter season, the energy crisis is still around. Gas shortages and coal shortages have become a bit less in Europe and China, but have not gone away. So oil demand for fuel substitution will remain. That's an incremental demand. In general, globally, yes, COVID is an issue again in Europe, but not on the global map as a whole. So in general, demand recovery is continuing, and OPEC, non-OPEC, despite the incremental output since July this year, is well below the growth in demand. So the market is being kept in a fair amount of deficit. All of that makes me generally constructive for crude prices, at least through the winter months.
On technical charts, analysts at Reliance Securities say WTI crude oil January may slide up to $77 to $75.44 level, with resistance seen around $78.80 to $79.50 level. On the MCX, crude oil for December series could see a bearish momentum up to 5,840 to 5,770 levels. The resistance, she says, is at 5,920 to 5,966 levels. Now, coming to Thursday's equity trading, F&O expiry will largely keep investors on the edge today. That apart, trends in global stock markets, the momentum of rupee against the dollar, and investments by FPIs and DIIs will sway the indices.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.